If you remember, we started talking about real options last week. And real options are different than financial options. In the financial normal options, we had an underlying security. We have a derivative. And you have the call option or put option, which gives you the right to buy or sell a security at a predetermined date, at a time on or before some maturity date. Real options idea is using the options idea, but we're going to use real options for investment decisions. And we talk about some of the investment decisions. So, for instance, we said normally when you have a project, what we do is we calculate the NPV of the project to figure out whether it's a good investment or not. And we say if it's a positive NPV investment, we should take it. If it's a negative NPV investment, we should ignore it. But in real life, we have more flexibility than that. So you have the option to wait and then take the project after a year or so. You have the option to abandon the project if things don't go well. You have the option for stage investment. So you enter a new market, for instance, see how things are doing, and then move to the second stage. So you will have a better place to stand on. Or you have the option to expand. You open a factory, then if it's not enough, you expand the factory. And then what else? Can you think of anything else? We have the option to for growth opportunities. It gives flexibility as well. So using all of those options, like real options idea, we might turn a negative NPV project into a positive one. I mean, not that we can turn it into a positive one, but the situations might turn a negative NPV project into a positive one. And last week, actually, we did a lot of examples on it. I think we look at the option to abandon, and we look at the option to for stage investment. And today we have a couple left. One is option to delay an investment, and the other one is, if I remember correctly, growth options. So we will try to find the value of those flexibilities, let's say. Okay, before we start, do you have any questions related to topics we covered last week? No, everything was very clear. Okay, that's what I thought. Now, let's look at the option to delay an investment. So, assume that you have negotiated a deal with a major restaurant chain to open one of its restaurants at Filistin Caddesi. The terms of the contract specify that you must open the restaurant either immediately or in exactly 1 year. Okay, so you have the option to delay. If you do neither, you lose the right to open the restaurant at all. So I have one question before we start talking about the problem. What is the advantage of waiting another year and not opening the restaurant? What do you think? What is the advantage of this option of delaying the investment? What is the disadvantage of opening?
You feel that the interest rates maybe will fall, then you can borrow a cheaper way.
If you're going to borrow, yes. If you have your own money.
If market situation is bad that year, you can then we can wait for good times.
Uh-huh.
There might be opportunity cost of opening restaurant when we can invest
something else. You're exactly right. So all of those are actually good things about having an option. So you can say, okay, I'm going to wait another year. I want to see the uncertainty to go away about whatever you have in your mind. Maybe you say, okay, I will wait and see how Günaydın Burger is doing. Or you can say, okay, how is Nam Nam is doing? I'm going to give it another year and figure out how another chain restaurant is doing. Or any of the markets worry, let's say, is related to this decision. Of course, there's a disadvantage of waiting. What is that?
Missing every opportunity during the year.
Exactly. You have this opportunity window, and if you miss it, maybe a competitor will step in. Maybe someone else will go and open that chain restaurant instead of you. So it is an if situation. So this time we're gonna see how well this investment looks like if we look at the NPV, and how the investment will look like if we have the option to delay the investment. If you remember, in those questions, this is generally what we do. We look at the NPV without having the option without real options. Then we calculate the value of the options, and then we add it to the normal NPV and see how NPV will change. Okay, let's look at this. So basically today you have the option to open the restaurant today. If it's the case, you're going to have the NPV of the project. If you wait, you will have new information related to the market or related to the industry, whatever. And then you can, after that new information, you can open the restaurant or you lose right to open. Remember, you have to make that decision in 1 year exactly. Okay, suppose that it will cost $5 million to open the restaurant today or next year. Whether you open it today or next year, you're going to pay $5 million. If you open the restaurant immediately, you expect to generate $600,000 in free cash flow. And suppose that future cash flows are expected to grow at a rate of 2% per year. So it's also like a perpetuity, right? So a growing perpetuity. Cash flows will grow at 2% and it will go on forever. The cost of capital is 12%. Okay, so what are we going to do? Let's look at the NPV of the project today. So what am I going to do? If I open the restaurant today, I'm going to get $600,000 a year forever with 2% growth rate. R is 12%. So the value of all the cash inflows are $6 million. What is the cost of opening the restaurant? $5 million. So the difference, $1 million, is the NPV, right? So it looks like it's a positive NPV project and you should open the restaurant immediately, right? So now let's consider the flexibility you have. Just because NPV is positive doesn't mean that you should open the restaurant right away. So maybe waiting another year will increase the NPV. In that case, you're going to wait 1 more year. Okay, then let's look at the situation. Okay, so the NPV of the restaurant, opening the restaurant today, is $1 million. Is there any question? Are there any questions here? Okay, that's straightforward. Now, what I want to do is I want to calculate the value of the options, and for that I need some information, which is here. Okay, so the payoff, if you delay the investment, is like a call option, right? You can delay opening the restaurant, and when you decide to exercise the option, you're going to pay the strike price, which is what? What is the strike in this example? If you open the restaurant, how much you're going to pay? $5 million is the strike price, exactly. And I need the extra information. Suppose that risk-free rate is 5% in the economy. Volatility is 40%. That's an important thing to calculate. How are you going to calculate the volatility of returns of a chain restaurant? You're going to look at a similar chain restaurant. Like you look at, I don't know, Nam-Nam's volatility, return volatility, for instance, earnings volatility, let's say. So if you wait to open the restaurant 1 year, what are you losing? You're losing $600,000 that you were going to make this year, right? So it's the lost money. And it is actually equivalent to the financial options idea and dividends, right? If you don't buy the stock now, you're foregoing the opportunity to get the dividend this year. The idea is exactly the same. So you are not getting the $600,000 cash flow. Like in the real like options case, you're not taking the dividend payment. Okay, so you're losing $600,000. So with this information, and this is the information we have, I'm going to go over this. With this information, what is the value of flexibility of delaying the investment 1 more year? Okay, current market value of the asset is how much? We calculated that, $6 million, right? It was $600,000 over R minus G. It is the value of the restaurant today, which is equivalent to the stock price, actually. So it is $6 million. You need to pay $5 million for the investment, which is like strike price. If you exercise the option to delay, then when you open the restaurant, you're gonna pay $5 million. You have to make a decision in 1 year. Risk-free rate is 5%, volatility is 40%, and cash flow from the lost money from delay is $0.6 million. So with this information, what am I going to do? I'm going to use Black-Scholes valuation. And I'm going to calculate the value of the option for delaying the investment. So how am I going to do it? I'm going to calculate D1, D2. I'm going to calculate C. And these are directly coming from it's directly coming from the formula, basically. But let's go over the formula, because there are a couple of things that are new. The first one is here. Normally in this formula, it says stock price over the exercise price. So 5 is the exercise price, $5 million. Where does this 546 come from? You know that stock price was 6 million. I wrote 6 million.
Is the present value
Present value of what?
6 million?
Okay, remember there's a lost cash flow. Do you remember that? Okay, you're losing $600,000, right? So if you deduct the present value of the $600,000 from the value of the investment, 6 million, it's going to be 546. This is what you're saying, I think. Okay, this is what I thought you were saying. So remember, in the first year, you're not getting 0.6 million. If you do 6 minus 0.6, it's going to give you 5.4, which is wrong. Why? Because you're going to get this 0.6 million at the end of 1 year. So you have to discount it 1 year back, bring it to today, then take the difference. It's going to be 546. Actually, we did those when we were covering financial options with the dividend case. We actually did that. So if you check your notes, you're going to see you already know how to do this. Okay? Okay, so the rest of it is just formula. You have the volatility, you have the risk-free rates. T is 1, everything is given. So from here, you can calculate the value of the call option, the value of weighting, which is going to be $5.2 million. So as you can see, here you have the calculation of the new stock price if you need it. So as you can see here, the value today from waiting to invest in the restaurant next year is going to be 1.2 million, which exceeds the value of opening the restaurant today. So what is better? Just wait another year and open the restaurant next year. So this is how you're going to value the option to delay an investment. Any questions? Okay. So as we said, if you wait, there will be less uncertainty for you. You're going to have more information, and this more information will give you a higher value on the investment. So in this case, you should wait to open the restaurant. Okay, if you calculate this, if you solve the same question with $700,000 cash flow every year instead of $600,000, things will change. So I actually, at home, you can try to solve this. So in the previous example, we used $600,000 as the cash flow of each year. Try it with $700,000, and let's see how it's gonna affect your decision. Okay? And the answer should be there actually under the notes. I think I put the answer there. Okay. So I have another question, but related to this one. So it says, suppose your current estimate of the restaurant's value is 6 million, the same question. What would be the value of the restaurant contract if the volatility of the restaurant's value were 25% rather than 40%? So without doing any calculations, if the volatility of the return is decreased, what do you expect from the call value?
Decrease.
Huh?
Decrease.
If volatility decreases, the call option to wait, its value should decrease. Very good. Alternatively, suppose the volatility is 40%, but waiting would lead competitors to expand and reduce the future cash flows of the restaurant by 10%. If this happens, what do you think is going to happen to the value of the option? The value of waiting, is it going to decrease or increase in the second situation? Increase or decrease? So let's read it again. Waiting would lead competitors to expand and reduce the future cash flows of the restaurant by 10%. So is waiting good in that case?
Yes.
No. So in that case, value of the option should decrease. Okay? So let's actually solve those. I don't think I have the answers here. Okay. So what am I going to do here? It's very, very simple actually. I just want you to have the answer, and I want you to see the intuition, whether the intuition will work when we use some numbers. So basically in the first case, the only thing I'm doing is I already have S star, which was 5.46. I have the strike as 5. Everything is same. The only thing that changes, the volatility became 25%. So in this case, if you use the calculation here, okay, so it's going to be something like this. So I have 5.46 over 5 plus risk-free plus the new volatility. T is 1. Okay, so the only thing that's going to change is the new volatility. So I'm not going to write the rest of it, but you should know C in the new case will be equal to 0.93 million. So if you remember, in the first case with high volatility, the value of the option was 1.2 million. With lower volatility, as you expected, the option of waiting decreased to 0.93. So it is better to invest immediately now. Why? Because if you open the restaurant today immediately, the NPV was 1 million. So in that case, don't wait. Open the restaurant today is the right way to go. And then in the second case, it says, now suppose that the volatility is still 40%, but waiting leads to increased competition. In this case, you're going to have reduced S star. S star will change. Why? Because your cash flows will reduce by 10%. So you need to calculate new S star. And in this case, you have 6 million, the value of the investment, minus the lost cash flow at the end of the first year. But then the value of cash flows will decrease by 10%. So you're going to take 90% of it basically. So 4.922 will be the new S star. The remaining things are the same. So again, plug the numbers in the formula. And if you do that, the new C will be equal to 0.85 million. Again, you shouldn't wait to open the restaurant. Another year, you should open the restaurant right away because the competition is making things very dangerous. So you should start right now. So when you're solving those questions, you should think about the intuition as well. And the homework questions I put, in the one question I put, it's more intuition than calculation. In that question, I just ask you NPV, and then I'm asking you about whether you should enter a market or not. So that question is more like an essay kind of question than calculations. So just look at the question, and hopefully you're not going to have any problems. If you have any problems, let me know. Okay, do you have any questions related to that? Okay. Then what else do we have? I think I have another example. Okay. So here, assume that your company is considering a project. Its cost of capital, its cost is 12 million. The project may begin today or in exactly 1 year. You expect the project to generate 1.5 million in free cash flow the first year if you begin the project today. Free cash flow is expected to grow at a rate of 3% per year. Again, a perpetuity question. There's more information. Risk-free rate is 4%, cost of capital is 11%, standard deviation of the project is 30%. The question asks you whether you should start the project now or wait another year. Again, the first step, calculate the NPV of the project without the option, as we always do. So you're going to get 1.5 million, cost of capital is 11%, growth is 3%. So from here, the value of the investment is $18 million. Then the initial investment is 12 million. The difference, 6.7, is the NPV of the project. So it looks like it's a good project. You should go with it. Okay. If you think about option to delay this investment another year, what you need to consider. One, you need to consider the value of the first cash flow you're going to miss because you're not opening the restaurant today. So you're going to have 1.5 million. You're discounting it by 11%. Please be careful. You're using cost of capital of the project when you're discounting the project cash flows. That's one mistake students make. And you're deducting this from the value of the investment. So the value of the investment S X is 17 million. After that, actually things are easy. You know the strike price is 12. Why? Because when you open the restaurant, you have to pay 12 million. Like when you exercise a call option, you have to pay the strike price. And SX, you already calculated. Volatility is given. It is 30%. Risk-free is 4%. T is 1 because you have to make the decision in 1 year. So from here, you can calculate the value of this value of the call option, which is 5.9. So would you wait another year or would you open the restaurant now? If you open the restaurant now, the NPV of the project is 6.7. The value of the call is 5.9. Okay, the answer is here. So basically, it's optimal to begin the project today. Why? Because starting the project now gives you a higher NPV. Okay, any questions? Okay, now let's move to another category. It's option to expand category. We talk about option to delay. Okay, option to expand. You have a factory, and then after 1 year or so, you're going to make an expansion decision, whether it's a good thing or not. Okay, suppose that you have an investment opportunity with an option to grow that requires a 10 million investment. In 1 year, you will find out whether the project is successful. The project will generate 1 million per year in perpetuity with 50% probability. And with 50% probability, this project will generate nothing. So what is the expected cash flow each year? $500,000. Thank you. It was just to check whether you're sleeping or not. Good. You're not sleeping, at least we know. Okay. And anytime you can double the size of the project. So you have the expansion decision. Risk-free rate is 6% per year. Okay, how are we going to solve this? Let's look at the picture first. Your first decision is whether you're going to invest in the project or not. And then every time you're going to know whether it's going to be success or failure. If it is success, you can double the size or you can stay with the same size. And you can make this decision anytime. Again, a perpetuity question. So as Alican said, when you invest today, the expected cash flows every year is $500,000. Why? Because you're generating 1 million with 50% chance or 0 with 50% chance. So the NPV rule will give you $500,000 over the risk-free rate. In this case, no other cost of capital is given, so you can use the risk-free rate. And you deduct the initial investment 10 million from it. So NPV of the project is minus 1.6 million. So in the first nodule, the decision to invest or not, the NPV decision tells you shouldn't invest in the project, right? Because it's negative NPV. Any questions here? I think you're zoning out a little bit. Is it very straightforward or? Okay. I hope it is very straightforward. Okay. Okay, so in this case, negative NPV suggests that you shouldn't start this project at all. But as finance people, informed finance people, we know that we should look into more things. You should say, okay, I have an expansion decision anytime. So let's see how much value that decision will generate. Okay, so now when you double the size of the project, of course, you're going to double the cash flow. So instead of generating 1 million with 50% chance, you can generate 2 million with 50% chance. So in this case, cash flows each period will be 1 million because of the doubling the size. Again, you are discounting it by the discount rate. This is not growing perpetuity. This is normal perpetuity. and you're deducting the value, the initial investment. So NPV of the project, if you double after a year, will be equal to 6.66 million. So as you can see now, it looks like a better idea to make investment, but we should think about one more thing. The value, this NPV is going to happen with 50% chance, right? You're going to double the size of the investment or do nothing. So what you should do is you're going to take 50% of it. So actually the expected value of the growth option will be equal to 33 million. So this is the value of the decision, expansion decision after 1 year. I'm taking it to today because I have to make the investment decision today. So if you discount it with the risk-free rate, you're going to find the present value of the growth option is equal to $3 million. So what you can conclude is, although this looks like a negative NPV project, since you have the option to expand for growth, that option might make things better. And in this example, you see that present value of this growth option is actually 3 million. So it's not minus 1.6 million value of investment. It generates you $3 million, which is a good investment. Any questions? Okay. Okay, so you turned a negative NPV project into a positive one, just adding this extra, very realistic thing. Because in real life, this is actually what you can do, right? You can expand the factory or the project. Okay. I think this is the last example, if I remember correctly. And this is probably the most complicated one. So I will try to go over this very slowly. Assume Startup Incorporated is a new company whose only asset is a patent on a new drug. If produced, the drug will generate certain profits of 1 million per year for 17 years. After that, competition will drive profits to zero. So this time, this is an annuity, right? Limited time, 17 years. It will cost 10 million today or in 1 year, okay, whatever you make the investment, it's going to cost you $10 million to produce the drug. The yield on a 17-year risk-free annuity is currently 8% per year. So it's basically the discount rate, okay? Discount rate on the annuity, and you're going to see why this is going to be important in a second. 1 year risk-free rate is 6%. Okay, discount rate, risk-free rate. What is the value of the patent? So now we will try to value something very hard to value. We will try to value a patent, and let's see how things will go. So the first one is calculating the value of the patent. So I said, or it says, if you produce the drug, you're going to generate 1 million profit every year. Okay, so this should be actually 1 million. Okay, I couldn't put zeros, just put zeros there. 1 million. Discount rate is 8%. You're going to get money for 17 years. This is the present value of an annuity, minus the cost of the investment. So it's going to be a negative NPV project. So it's not a good idea to invest in this drug. It's a negative NPV project. And today's interest rate is 8%. We made the calculation with 8%. Now I'm going to say, what happens to your decision if interest rates fall to 5% or increase to 10%? How things will change? And from here, actually, I'm going to calculate the value of the patent, looking at the interest changes. Actually, interest changes is all about change in discount rate. It's the discount rate in your investment, discount rate of the patent. Okay, so if rates increase to 10%, the only thing you're doing is you're going to change this using the new interest rate. It's going to be 10%. So in this case, of course, this number will be smaller or bigger if you increase interest rates. Thank you. If you increase interest rates, present value will decline. The basic relationship, if you remember. Okay, in this case, NPV will be even more negative, right? So if interest rates increases, it doesn't make sense to invest in the drug at all. What if rates fall to 5%? If rates fall to 5% after 1 year, what's going to happen? Interest rate changes after 1 year. So you're using the new interest rate 5%. You have 16 payments left. It was a 17-year project, but we moved 1 year ahead. So 16 years left. And whenever you produce the drug, you're paying 10 million. So I don't have to do anything to this. So the NPV of the project will be 837. So if interest rates fall to 5%, then it makes sense to produce that drug. Okay, let's move. So there are we are at time 0. At time 1, interest rates might increase or interest rates might fall. If interest rates increase, if you invest, it's going to be negative NPV, or you have the decision not to invest, so your NPV will be 0. So whenever I'm here, I'm not going to produce the drug, for sure. Right? I'm going to stay with 0 NPV. If rates fall to 5%, if you invest, my NPV will be 837. If I don't invest, my NPV will be 0. I'm not generating any money. Okay, now what am I going to do? This is the kind of a tricky part. I put this question because it is different than what we always did. In this question, we are assuming risk neutrality of the investor. And when I say risk neutral probability, you already know how to calculate risk neutral probabilities and stuff. But normally what we need to do is, in the risk neutral world, I need to make the return on any investment equal to the risk-free rate. So in this case, what am I going to do? I'm using a 17-year risk-free annuity, and I'm going to assume I have payments of $1,000 on this risk-free annuity. Remember, I'm interested in risk-free return on any investment. So I'm going to use $1,000 payment, 70-year of annuity, but you can use this payment to be anything because it's just one number. So you can take it 1, 2, 3, 1 million, 10 million. The result is not going to change. Just understand the idea. So I'm going to say, remember, I'm interested in risk-neutral probabilities. In the risk-neutral probabilities, I need S, SU, SD, CU, CD, if you remember. Okay, that's why I'm doing this calculation. I need an S value, I need an SU value. Okay, so the S value is the current price with 8% interest, 17-year project, and my payment, random, made-up payment, is 1 million. Okay, again, the result is not going to change whatever number you use here. It has nothing to do with generated profits. In that case, S will be equal to 9122. Then I need SU and SD. SU case, I assume interest rates increase. If interest rates increase, this is going to be the value of the 16-year left annuity. Then I have the one payment that I need to consider, which is 1,000. So together, SU will be equal to 8824. I'm going to do the same thing for SD. When the rates go down to 5%, I'm going to do the same thing. I'm going to do the same thing with 5% interest, and I'm going to calculate SD. So now I have S, I have SU, SD. Then what am I going to do? I need the risk-neutral probabilities. And if you remember, this is how we calculated. 1 plus risk-free times S minus SD over SU minus SD. From here, the probability of having interest rates to be 10% is going to be 72%. So with 72% chance, interest rates will increase to 10%. And the remaining probability, 30%, interest rates will fall to 5%. After that, the rest is easy. So now I know that interest rates will go down to 5% with 30% probability. In that case, NPV was equal to 837. We already calculated that. And with 70% probability, interest rates will increase to 10%. And when interest rates increases, NPV will be 0 because you're not going to invest in the drug. And these are the NPVs you get after 1 year. So you need to discount those by 1 period. So the value of this growth opportunity will be equal to $200,000. So basically what we understand from here is it was a negative NPV project when we started with the current interest rate. But because we have the probability of interest rate changes in 1 year, this bad investment turned into a good investment. And since the question talk about risk-neutral probabilities, I needed to make the return on any investment equal to the return on risk-free rate. That's why I made up that annuity, okay, with random payment. And with that calculation, I found that the firms to use the patent and grow will be equal to $221,000. So it became a positive NPV project. Any questions about this? No? Okay, then to sum up, what we learned, I hope, is that even if an investment has a negative NPV, you can, the situations can make it positive, okay? And the option to delay may be worth more than the NPV of taking the investment today. Think about the Filistin Caddesi restaurant example. And actually with waiting, with any kind of flexibility, you're adding value to your investment decision, which is very realistic. I hope you're aware of this. Hopefully you're going to be managers at some point, and you need to think what makes a good manager is how flexible he is, depending on situations, and how mobile he is or she is. So you should be aware of all of those decisions, right? And you should question those. And you can use those in real life situations, as you can see. So whenever you have an investment expense, delaying it might make sense because you're reducing the uncertainty. And you can basically create value of the investment decisions using the real options framework. To be able to use the real options framework, you should know options really well. You should know how to use binomial approach, risk-neutral approach, and Black-Scholes approach. And with this, you can basically tell someone, tell your boss or something, or your colleague that using the discounted cash flow analysis is good. It's a good first start, but you should explore other opportunities as well, and you should keep your options open. Okay. Any questions about real options? No? Then that's all for today. We're done.